Vanguard just increased their return expectations by 40%. 40%. This is just, I don't understand this at all. I mean, I understand their numbers. This is just odd to me how quickly this happened. Anyway, this is weird. So we're going to go into it and we're going to dive deep on how I came up with this. So this is from the article I just did a video on yesterday. From the Phoenix, a 60-40 portfolio will rise again. All right, and so I just want to show you real quick. There are assumptions that I'd never understood this, but I've never heard this stated before, but here they are. Keep in mind, the goal of the 60-40 portfolio is to achieve long-term annualized returns of roughly 7%. I've never heard that ever. I've never heard a goal to say on a 60-40, our goal is 7%, but okay, and we'll take it. But that's weird that they're stating that emphatically. I've never heard that. My goal is to get what I can get with a little bit less risk than a 100% stock portfolio. Be it as it may, the annualized return of the 60-40 portfolio going back to 1926 was 8.8, excuse me. So, I mean, 7% is significantly lower than 8.8, but I'm sitting there thinking, well, even Vanguard wasn't keen on the 7% up until literally I read this article, and this was dated July 1st. Like, huh? Anyway, so let's see what I said. How do you get in that Vanguard? Going forward, the Vanguard Capital Models Market, and that's what a Capital Markets Model, VCMM, Capital Markets Model. I always get it mixed up. That's what I use in my own software, Right Capital, that I use. So when I'm running retirement plan projections, I use the Vanguard Capital's Models Market, whatever it is, VCMM. And I'm not updating it now. I'll wait to the end of the year, but I only update it once a year because I don't like updating it in mid-year. That doesn't make sense to me. Anyway, so that's pretty near and dear to my heart, the VCMM. And I'm like, what? Anyway, so going forward, the VCMM projects a long-term average return to be about 7% for the 60-40 portfolio. I'm like, what? Where'd that come from? Market volatility means blah, blah, blah. Okay. The projections and other information generated by the VCMM regarding the likelihood of various investment outcomes are hypothetical right now. Let's see, hold on a second. The math of average returns suggests that periods of negative returns must be followed by years with higher than average returns. What? Periods? I mean, the math says that, yes, because if you're getting a 7% average, you're only getting 5%, inherently you got to get 9%. Okay, but check this out. Indeed, with the painful market adjustments year to date, the return outlook for the 60-40 portfolio has improved, not declined. Driven by lower equity valuations, the VCMM's projected 10-year returns for stocks have increased by 1.3%. And you're going to be like, how did you get 40%, Josh? It's actually bigger than that, but I'll show you. Since the year in 2021. Are you all hearing that? The VCM's projected 10-year returns for stocks has increased by 1.3% since the end of 2021. And with higher interest rates, VCM projected 10-year U.S. bond returns have increased by 1.6% from year-end 2021. Overall, the 10-year annualized return outlook for the 60-40 portfolio is 1.3 percentage points than before. All right, so I'm like, well, that's odd. So I'm going to go back to May of 2022. This is their market perspectives that they had written at the end of April. And this is what their perspectives or their presumptions were. Asset class return outlooks. U.S. stocks, we're just going to round for simplicity, 3.5%. All right, so they're saying the return projections for U.S. stocks over the next 10 years are 2.8 to 4.8, just for simplicity, we're going to say 3.5. Our 10-year annualized nominal return, that's before inflation is factored in. Global stocks are 5.7 to 7.7, so we're going to say 6.5. All right, so now let me show you what I'm doing here. So Vanguard 100% stock portfolio, all right, so if you got Vanguard's 100% stocks, they got, I don't know how to do this, 40% and 60%. It's like a Pac-Man. So Vanguard, 40% is allocated international. This is a 100% stock portfolio, 60% allocated domestically. Hope that makes sense. So, all right, what we're doing now is we're going to take what they expect for U.S. stocks, which is 60% of their 100% stock portfolio. Hang in there. This will make sense when we're done here. And we're going to give them 3.5% a year. I'll just give it 3.8. That's fine. 038. We'll just give it 3.8. Now, 40%, because Vanguard is high on international stocks, which I'm not, but 40% of their portfolio, of 100% stock portfolio, they'll give, we'll say 6.7. All right. So what we do so far to get the stock return projections with a 100% stock portfolio, we take 60%, which is domestic, we times that by 0.038%, because that's 3.8% rate of return. Then we take 40% for the international, we times that by 0.067. All right, so we take our calculator and we say 0.6 times 0.038 equals 0.022. All right, then we take 0.4 times 0.067, that equals 0.026. We'll actually round that up to 0.02. Actually, both should be rounded up. So 0.023 and 0.027. All right, cool, perfect. Perfect. 0.023, 0.027. All right, so that's what we have. So of the 60-40 portfolio, they expect the international to give us 2.7% a year rate of return, and the domestic to give us 2.3% rate of return. We add those up together, and that gives us nice round 5%. 5% rate of return. Hope that makes sense. All right, good. So now what we're going to do is we're going to say of that, stocks give us 5% rate of return. Just hang in there with me, my friends. Equals 5%. All right. But now with stocks only 60% of a 60-40 portfolio. So now we got to figure out what bonds are going to do. And we're just going to use the aggregate bonds. I don't care about global bonds. I'm just going to use the aggregate bonds. That's what's that? 2.5, 2.4. So bonds are now going to give us 2.4. All right. So what we do is we take the bond portfolio. All right, so now what we're going to do, the bonds equals 2.4%. So of a 60-40 portfolio, stocks will give us 5%, bonds will give us 2.4, but we got to do it in terms of their proportion. So 0.6 for the stocks equals times 0.05, and 0.4 for the bonds times, I keep doing equals, times 0.04, 0.024. All right. So this is what we're coming up with. So 60% of a 60-40 stock portfolio will give us 5% rate of return. So we take our trusty calculator, 0.6 times 0.05 give us 3. That gives us 3% rate of return on the stocks of the 60-40 portfolio. Bonds, 0.4 times 0.024 equals less than, we're just going to round up and say 1%. It's actually 0.096. I'm just going to round up to say 1 for simplicity. So we take the 3% from the 60% stocks, and then we take 1% from the 40% bonds, which is 2.4%, and that gives us a 4% rate of return. That was literally in May. This is what Vanguard is saying. A 60-40 portfolio will equal 4% nominal rate of return. How do I know that? Because I look at their freaking numbers right here. It does piss me off, I'm not going to lie to you. Because I say, wait, we're changing on the fly. U.S. equities, 3.8. Global equities, 6.7. And U.S. aggregate bonds, 2.4. And that gives us a 4% rate of return. You can do the numbers yourself, and I am right. Now we go back to what they're saying now. And this is freaking insane, man. All right, so let's go back to what they're saying now. We expect, hold on, where was it? Right there. Our outlook for a 60-40 portfolio is now 1.3 percentage points higher than what it was before. So now what we do is we were getting 4%, now we're getting 1.3% above that. And I'll show you another way this is nuts. We divide 4% by 1.3 by 4. That's a 32 point. So basically what's happening is if we add 1.3% because of market adjustments, because the markets are way down, to a 4% portfolio, we're getting a 5.3% rate of return, which is 32.5% higher than what it was literally back in April and at the end of April. But what the hell? But it's even worse than that, man. It's even worse than that because they're saying that Vanguard expects. Let's see. They expect the average rate of return will be 7%. Oh, let me find that. Average return we expect can still be achieved if periods of negative returns like this year are followed periods of high returns. Well, no crap, Sherlock. But anyway, this is crazy. And that's their expectations to receive a 7% rate of return. I don't get, but anyway, so I'm not even going with that. That doesn't make any sense. So I'm sitting there thinking, okay, so even that's still a 32.5% increase in projected returns. I mean, that's a significant deal. We're still only sitting at what, 5.1, 5.3. But let's see what they said in their market expectations because remember, they're saying their market expectations, they increased their market expectations from December 2021. It said here someplace right here. Right here, December year-end 2021. So let's see what their market expectations were, because maybe this is significantly lower. I don't think so, but let's see. We are. This is literally December 2021. And here we go. U.S. equities, 3.3. Global equities, was that 6.2. I mean, it's literally basically what I was just using for for May. Bonds, I mean, almost the same thing, a little bit less, but 1.9. I don't get it, man. I mean, whatever. I'm not changing. I just don't. Let's make sense. And this doesn't make sense. But, if you need optimism to stay in the markets, there you go. And I actually agree with the sentiment. When the markets are down 25%, that inherently means there's more upside than there was just 6 months ago, because the markets are already off a quarter. A quarter of your capital is lost. The likelihood of another quarter of your capital going down isn't very high. But the likelihood of going up is higher now, because you just lost a quarter of your capital. Buy low, sell high. Anyway, love your thoughts. It's interesting to me, but I'm not sure we're out of the woods yet. So hang tight. I love you.